Hi guys, it's Alex here. Hope you are all well. Today we are going to see Ron Barron take on Tesla stock price and other news about Tesla, the stock market, tech stocks, and the real estate market heating up. Let's dive right into it.
We heard from billionaire investor Ron Barron early this morning, and he has a message for CNBC viewers. He wrote an email to Joe and I in which he writes, "This is a huge, once-in-a-generation buying opportunity. Huge, monstrous opportunity following June 2022, June 2020 as well crash." He told us about how he was talking to his sons who've been in the investment business for about 20 years now, and he suggests that they now have the same opportunity he had when he founded Barron Capital back on March 16th of 1982. That's when the Dow Jones Industrial Average was at 880. Yes, we're crying today about it falling below 30,000 for the first time since January of 2021.
Doubled in 22 years. So his point is the market could be spring-loaded if you have a long-term perspective. And as I said, we're certainly not cheerleading because most people think that we have a way to go.
Right. This is not saying that if you put this money in,
Right.
it's going to come back and quickly make returns. This is about looking at things over a very long perspective. And that long haul, if you have the patience, if you are taking money that you're not leveraging, the money that you don't need to pay your bills today, right, that's important to find some of that cash and set it aside. And that's how you have the time horizon to actually watch compound interest build up.
I mean, we have highlighted the risks that still are present for this market with Katie Stockton and the VIX. Crappy VIX is still only 30. Even after yesterday, I think it's at 32. And people think you need 40 before you make a real bottom. So we're not taking either side, but long
term. It's not going to be if you're day trading. That's not what this is about. This is being a long-term investor, realizing that if it's sitting in cash, sitting in a bank account where you're not getting returns, you are losing value. And this is something that Ron Barron's been very consistent on over the years, just the idea that you can't let your money sit in cash. It gets, your spending power dwindles away.
Well, if you were a young Ron Barron right now, and if it went from 880 to 30,000, figure out where we are now at 20,000, 29,000. I mean, the number would be up in the hundreds of thousands, theoretically, if it really is the same type of opportunity.
Let's look at Tesla stock price chart and compare where we are now to when the pandemic hit. When the pandemic started, Tesla went down 52%. Then it went ballistic, going up 13 times. Where we are now, Tesla stock down from the peak to now 47%, 48%. According to Ron Barron, buying Tesla stock now is a monstrous opportunity. I did this video about Ron Barron Tesla stock price prediction 2 weeks ago. Click the card in the corner above to watch all of it.
Right now, than I would. I own 1.25 million shares for our firm in the company. I have not sold a single share of that, and I don't expect to.
Okay.
In my lifetime.
In your lifetime, you don't expect?
In my lifetime.
Okay.
And the same thing with SpaceX. So I think we're going to make 3 or 4 or 5 times our money in the next 10 years in Tesla. And I think it's
again from on top of the 20 that you've made.
Let's look at the stock price today for Tesla. $759 back when this video was filmed. Was 7 April 2022. Tesla share price was $1,066. If you multiply by 5, Ron Barron says that he will 5x in value in the next 10 years. You get $5,330 per share. Now you divide this by the actual price, 759, and you get a multiple of 7 times. So Ron Barron is betting that Tesla's stock price will go up 7 times from today. Now, if you do the math again, it's even better because Tesla stock is cheaper now than 2 weeks ago. If you invest today in Tesla stock, according to Ron Barron, you have a chance to make 8 times your money. Speaking of monstrous opportunity, Tim Armstrong, founder and CEO of tech startup Flowcode, somehow agrees with this and says today is less risky to invest than it was a year ago in 2021, and sees tech stocks with better valuation now, and that it's a great point to start investing.
Talk to our group. So I feel like in the last week I've gotten a good look at how everyone's feeling. I think the sentiment on the tech side is that this issues we're facing are going to be someplace between the financial crisis and the dot-com blow up. I think the growth investors have incredibly slowed down the spend, and in some cases turned them all the way off. And the large cap investors seem like they're time's on their side, so they're waiting. So I think the tech business and the tech market got the huge tailwind from the pandemic. The valuations have gotten really crunched. I think there's a lot of throwing the baby out with the bathwater. There's a lot of great tech companies that are probably getting to a valuation point where it wouldn't be a bad time to invest. Let's put it this way: it's less risky to invest now than I think it was last year at this time, or last fall, when valuations were probably not 100% real. And I think the knock-on effect of this is going to be similar to the dot-com bubble, where for the big tech companies that rely on advertising, they're going to get a huge benefit from the data changes at Apple and Google, and streaming video is going to get a big benefit. But there's also going to be a pretty sizable net negative when the venture-backed companies lose their ability to spend customer acquisition dollars almost at any cost. And I think that's going away right now, just like it did in the dot-com bubble. So net, I think tech is a great long-term investment. I think the prices have come way down. There's probably going to be some more bumps in the road, but I'm bullish long-term. I heard Kate's report. I'm super bullish on crypto also, for a bunch of different reasons. But I think that market was probably overvalued, but I think long-term that's going to be a very valuable industry.
And other Tesla news. Elon Musk hints Tesla could bring back enhanced autopilot worldwide. What's enhanced autopilot? All features of basic autopilot, navigate on autopilot, an active guidance feature for enhanced autopilot that, with driver supervision, guides the car from a highway's on-ramp to off-ramp, including suggesting and making lane changes, navigating highway interchanges and taking exits, auto park and summon. The basic autopilot, adaptive cruise control, emergency braking, blind spot monitoring, lane keep assistance, all of this go with enhanced autopilot also. After Tesla introduced enhanced autopilot in Australia and New Zealand earlier this week, Trevor Page, founder of the Model 3 owners blog, suggested Tesla bring back the enhanced autopilot program as FSD is too expensive for what you get. Page went on to suggest Tesla should offer basic autopilot for every vehicle, while enhanced autopilot would be available for a lower price than FSD as limited offering. FSD would still be available for purchase at its normal price tag of $12,000. Musk simply replied, "Okay," hinting the options may be available. Tesla Model 3 depreciates unlike any other EV. How quickly does a Tesla Model 3 depreciate? The Tesla Model 3 depreciates only 10% of its original value within the first 3 years. That's very good, according to a study by IC Cars. That is unheard of among EVs. However, that does mean that used EV shoppers interested in the car will only save an average of $4,720 over a new model. Still, it's excellent news for current Model 3 owners, especially those considering selling or trading in their EVs. And now the real estate market. We can see signs of slowdown in real estate market.
Anxiety hitting the real estate market. According to a new survey from data platform Dynata, 81% of Americans say it's hard to find a home to buy or rent right now, mostly because of high prices. Mortgage rates are a big part of that. They're rising at the fastest pace in decades. Home sales are suddenly slowing, and data shows new home construction in May declined more than analysts expected. So is housing in for the same kind of crash we saw in the Great Recession? Here's CNBC's real estate correspondent, Diana Olek.
During the Great Recession, when home prices positively crashed, millions of homes went into foreclosure. That was because the mortgages holding up the housing market were a mess. Lenders were basically giving anyone a loan. Not so since then. For the 53.5 million first lien home mortgages in America today, the average borrower credit score is a record high 751. It was below 700 back in 2010. And thanks to the recent run-up in home prices, those borrowers have record tappable home equity. That's how much you can take out of your home and still leave 20% equity in it. $11 trillion in total, up 34% from a year ago. That's a significant cushion in case home prices soften or even fall.
If the economy were to slow significantly, then we could potentially see a home price dips. But that's not my base case. My expectation is that we'll see home price grow.
During the Great Recession, 1 in 4 homeowners was underwater on their mortgage, meaning they owed more than the home was worth.
So when it comes to the financial position of homeowners in the aggregate, housing is on really solid footing right now.
So what about the riskier loans? Well, there are just 2.5 million adjustable rate mortgages outstanding today. Compare that to 13 million in 2007, just before the housing crash. A little more than half of those today are about to reset to higher rates, so there is a risk. But back in 07, about 10 million of those were resetting higher. Mortgage delinquencies are now at a record low, just 3% of loans, which is actually less than before the pandemic. The real risk to housing right now is affordability and recession. Prices are still so high that some new buyers just can't get in, and sky-high rents make saving for a down payment very difficult. As for current homeowners, if a recession hits and people start to lose their jobs, then they may struggle to make their payments, especially if they stretch to buy that home in the first place.
After stock and crypto market got hit, now it's real estate time. Knock knock. You're next. Funny. What's your opinion on all of this? Leave a comment below. If you like this video, please smash that like button and subscribe. See you next time.